This is episode 2 of our interview with Douglas Olson of USI, an independent insurance advisor. Hello, all. This is Dennis Day with Getting Your Edge, How to Downsize Your Home. And we have a fantastic show for you. Thanks for showing up. I'm here with my co-host, Judy Gratton. Welcome,
Hello.
Judy.
Good morning on this wonderful spring morning. The last time we heard Douglas, I was like, oh my God. One of the things that I heard you say the last go around was that to help protect your insurance, I guess would be a good way to say it. You need to consider that it is there for, what did you say? Catastrophes.
Yeah.
But what you're saying to help prevent this from happening, your insurance policy is not there for every little thing that goes wrong. Should not be considered for that. Is that right?
Yes. And remember, I'm offering food for thought. I'm not providing direction to say this is
Right.
what you should or shouldn't do. But as an accredited advisor of insurance, that is the advice I'm offering to those. While we're not going to dig into it here because it'd be a 4-hour conversation, what I will say is the following. If you think about, let's just say you bought a home in early 2000 and it cost you $180,000. That same home today, if you went to sell it, is probably, in our area anyways, an honest $500,000 house. Can we agree on that, Judy? Yeah, I'm being kind. What's happened is in those 25 years that we've had that insurance policy, we still have that exact same $1,000 deductible. Why? If we were willing to have $1,000 deductible when the reconstruction cost of that home was $180,000, and now it's $500,000, we're not allowing ourselves to do the math to go, hey, that's probably not appropriate anymore. And if we're willing to pay $1,000 when it was $180,000, we probably should be looking at $2,500 or $5,000 today, because that's how much risk we were absorbing inside that $180,000. We also have to be honest with ourselves and just go, gosh, why would I make that claim? And to answer your question specifically, please know that there are multiple different levels of insurance. And what do I mean by different levels? There are levels of, I've had a lot of losses and now I have to pay extremely high expenses, so I'm going to push the coverages down as much as possible to push down that premium until I no longer have those losses showing on my record. And then there's what we like to call the middle market, which is your Allstates, your USAAs, your State Farms. They were built on 1,200 square foot homes with a nice, beautiful car in the front yard. And now those homes may be worth $1 million or $2 million. And we're getting to the end of their rope on what they feel is okay for them to not have to either go into the reinsurance market and spend even more money to offer coverage that you're going to end up as a consumer paying for. And then you have what we call the private client level of coverage. And what that basically means, if you think of folks that are in $1 million or greater valued home, and we're talking reconstruction cost here, not just the perceived value of its view and location. If you're looking at that market, now you're working with carriers that are designing and critiquing their policies to make sure that client is taken care of the way they think they're going to be taken care of on claim day. The middle market insurance companies are going to take very good care of us for the majority of what's going on, but they're not going to have any nuances. They're not going to have any additional protections. There's other things that those carriers are limited to because that's how they're keeping their insurance rates down and acceptable, because they don't have those coverages. And then the other thing I want to bring to everybody's attention is there's more than one insurance policy that you can get for a home, and there's more than one you can get for an auto with nearly every single insurance carrier. This is why it's important to work with someone that has you in their best interest, and you're going to be having an advocate work on your behalf. Because if you do that, you're going to have someone say, would you like the basic policy that has thousands of exclusions? Would you like a policy in the middle that maybe only has 500 exclusions? And we'll talk through those, of course, when we're having that conversation. Believe it or not, most people think they have that coverage, but they're paying for the other one. And then that's why they get mad on claim day when they find out the insurance contract isn't covering them. So as we're talking about deductibles here, it's smarter to be having a holistic conversation at this point to say, what coverages do you really have? What are your risk tolerances? Meaning, what do you want to pay for in your own? All of this comes back to insurance right now should be used as a catastrophic policy because we should be absorbing those inconveniences. We should be taking on, I like using the example of if there's someone new in the household that thought they put it in reverse, but they put it in forward gear and took out the bottom of your garage door, please don't call the insurance company.
Yeah.
Please call the garage repair folks and pay for that out of pocket. And I know this is important to also understand. As we talk about these different insurance carriers, they all now have limitations they may not have had just 6 months ago or 2 years ago or 5 years ago. Yeah, not during the contract period, but you do get this thing called a renewal offer every year. If you're not reading that renewal offer and those pages that come with it, and you're just going, what's the premium? And then your brain goes, oh my goodness. May I ask that you turn the first page and put it over there first and look at the other pages and go, what language in the contract have we changed? What are we proposing for your consideration? If you pay that premium, you have accepted those changes. Every single renewal, if there has been an adjustment or a change in how their policy will react to you on claim day, you've accepted it because you paid it.
Can I ask Douglas, though, and I've said this myself, I've paid into that insurance for 15 years and never had a claim.
Yeah.
And I get one claim and they raise my rates.
Yeah.
What do you say to folks?
First, I give them a hug. And I say, remember, I'm a consumer and I work for you. I'm not the insurance company, so please don't hit me. Sometimes I do, by the way. I'm not joking. Hey, I'm a consumer too. I get it. I understand. I've made claims. And guess what? I now have a little bucket of money somewhere for those unknown things. So here's the deal. What a lot of people have forgotten for whatever reason, because they haven't done an insurance review in a while, or it just wasn't, there's only so much room in our brains for what's important. And we want to keep the knowledge, right? We don't all need to be insurance experts. That's why it's important to talk to an expert when you're having this conversation. Here's the deal. When we talk about if you make a claim and you haven't made a claim in 5 years or more, you're immediately getting a 10% no claim discount on every policy within reason that you already are buying. So immediately, if there's a 20% rate increase or a 10% rate increase, just normally because of the cost of materials and labor and what the insurance commissioner approved for that insurance company, and you're going to have that raise happen, and then you lose the 10% no claim discount, you're adding another 10% to that rate increase. You're thinking, gosh, I never used my insurance before, but there's one more element we haven't even discussed yet. And that is, depending upon the severity of that loss, you could see another 10 to 40% rate increase when you activate your insurance. And that's why consumers start getting frustrated. That's why I'm saying to you, please think of it as catastrophic. And if we're going to have this honest conversation about catastrophic, and let's say you're going to say, I want a $5,000 or a $10,000 deductible, you need to know that you're going to absorb that first $5,000 or $10,000 deductible on your home. If you're spending $2,000 a year on your insurance, and let's go worst case scenario, and you lose your 10% discount and you get a 40% surcharge. We're just going to look at the 40% number that we were just talking about here for a second. So now your insurance is going to go from $2,000 to $3,000 for 3 years. That, if you do the math, that means they're going to get $3,000 out of your back pocket over the next 3 years. But you got a $1,000 deductible. So you also paid the $1,000 for the insurance company to help you. So you're out $4,000 in 3 years. So why not have a $5,000 deductible? And instead of paying the insurance company permission to have a low deductible, this drives your insurance rate down by $300, $400, $500 a year. So now instead of being $2,000, maybe it's $1,600. And you start adding all this money up, it totally makes sense to have a $5,000 deductible and look at your insurance policy for the 20, 30, 40, 50, 100 total loss, whatever that value might be on your insurance policy. You really do need to build a strategy around your own risk tolerance and what you're willing to pay out of pocket.
Douglas, you've said that the insurance companies they bring in $1, they pay out $5. Why is that happening right now?
Trust me, if they did, I'd be living there. They don't have a crystal ball, so they can't project, are we going to have the Palisades lose 500 houses in January 2025? They don't have that crystal ball. They don't have the ability, other than they know that there's a tornado alley and that hurricanes do come and go, and Now they're building codes for those kinds of areas, and we continue to evolve as human beings. We try and batten down our hatches, so to speak. And this is why insurance companies are leaving forestry type areas, because if we don't have the responding fire departments and we don't have the resources to knock the fires down, all these elements come into this. The insurance companies have a contractual obligation to write those checks. That's the advantage that we have. Because we do have these insurance contracts, they are writing those checks. That doesn't mean on claim day that they're not looking at that contract and make sure that they're squeezing every last possibility to not add to that check. And that's why it's important to know the catastrophic policies you've chosen to put in place are going to take care of you on claim day if and when that ever happened.
Are there things in the world? I mean, we've talked about Florida. Seems like the insurance companies are fleeing California because of the fires. Are there other areas and other reasons that insurance companies are leaving?
Yes, and I'll get this to Judy as well, if I have not already, Judy. I mentioned earlier in this podcast, the Senate had actually brought this information together, and it's probably going to be rather eye-opening for the majority of folks that look at that. Understand this is not something I created, just want to be clear. It's not something the insurance industry created, but the Senate did, and they pulled this together, and you'll see these colors going across the entire country. I don't remember there being a state that is not seeing companies non-renew policies. Just because a company has chosen to not renew doesn't mean that they've left the industry. If they do a satellite view and they see that the trees are not maintained, or the gutters have weeds growing in them, or there's moss on the roof, or there's a car in the front yard on blocks, or the lawn doesn't look maintained, it doesn't look right. Those are higher risks for insurance companies. A slip and falls when they order an Amazon item. Think of the weaving and dodging and all these things. Or because the rain gutters are not clean, that water's now wicking back up on the roof, and now we're going to have a water damage claim. So insurance companies, I think this is probably a good place to say this, and I apologize for not saying it earlier. There is a relationship responsibility that we have as consumers, and that is to understand that insurance companies are a transfer of risk for an agreed cost to us as consumers for them to take on that risk. Insurance companies are designed to take on risk. They're not designed to take on, we know it's going to happen and we're going to have to write a check. They've got to be careful and understand that. While we may want to buy something because we love the view, doesn't mean insurance companies by law have to cover you. They're a business. And if that risk is too great for their algorithms and how much they're going to be able to charge you, because remember, as consumers, if they say $20,000, but somebody else wants to give you that same policy for $2,000, are you going to write the check for 20? Or are you going to write the check for 2,000? But when that carrier that was offering it for 2,000 leaves the market because they were not getting enough premium, they were buying the market, or they were trying to get it going so they felt they could get enough premium to make up for it. And then they find out, like in today's environment, that they can't, so they're leaving the market. This is where consumers get upset, because that same carrier that was offering the $20,000 policy is still there. And they're still offering it for that same $20,000, or there might be some adjustments. So we do have to be careful. And that's why we say, look at this as a catastrophic. Make sure you're building a strategy. Let's make sure you're putting something in place that's going to react the way you want it to on that claim day, not just how much am I paying every month out of my pocket or every year for the policies.
So, Douglas, I don't know if you remember, but a few years back in the state of Washington, there was an addendum that was added to purchase and sale contracts that was strictly around the buyer being able to verify that they could get reasonably priced insurance. And at that time, it was considered 1% of the purchase price. It had to be under 1% of the purchase price. And it was tied to something, and there was an acronym for it. Now I've forgotten what it was. Turn down or not, no, that's not covered. If I call and say my tree fell in the front yard and they say, no, that's not covered, because mortgage, if you're getting a mortgage, they require that you have insurance. And if you don't get it, they'll get it for you. And it's generally more expensive. So this addendum came into play to protect the buyer from getting stuck with outrageous insurance, so they could go away from the property if that was going to be the case. Do you see that coming into play again now around in our area at all?
I want to be careful how I answer that, and just say that insurance has to collect the correct amount of premium for the risk. And I could also say to you, it's not unusual for a mortgage broker to send me an email to say, your insurance is too expensive. I've been in this business for a while and it should only be $800.
Oh,
That's nice. Thank you for your email. Even with all of my expertise, I cannot go to an insurance company and say, push your pricing down. It's controlled. It is what it is. So on insurance side, it's a report that shows and demonstrates claims that have been made. So it's a gathering of insurance information, no matter what insurance carrier
and
you
is that recorded both against the person and the house?
Yes.
A house by itself, even though the sellers are selling it, the new buyer is they're looking at that house and seeing that a lot of claims had been made against the house. If someone's working with you and they have a question about their policy, can they call you and not end up with one of those dings on their history?
It's a really valuable question for you to ask, Judy. And my advice is always, whenever possible, if you do have a relationship with your insurance agent, whether they have acronyms behind their name or not, the agent, not a supporting person, not the front desk person, the agent, we have an advantage. And that advantage is we get to be human. So if you call and say, hey, I have a question, can we unofficially have a conversation? We need to pro and con these things. Absolutely. But if you call someone that's paid to record conversations, you call the insurance company directly.
Do they record those conversations?
Yeah, oh, the insurance carriers absolutely do. Yeah. I don't want to get into that. But every time I'm calling, I'm hearing them say we're recording for training purposes and blah, blah, blah. So I do think that they are letting us know when those recordings are happening. And it's not to be against us. It's also to keep them honest. So if someone is giving them misinformation, that client can be provided the coverage that they were told that they had that they don't have, as an example. So it really is for training purposes and making sure things are accurate. If you're communicating with someone at the insurance company, they do have rules, regulations, and requirements that say, we're going to open this claim, even though you're saying I'm not going to have a claim, because you want to have a dialogue with me as an insurance company. And let's look at this as us. Don't we want to know how their production is? So we make sure that they're doing their job. So now you may lose your 10% no claim discount because you reached out to that insurance company.
Even though you don't end up actually.
100%. That's why you'll see zero paid out so often on these reports. And again, we had that conversation a moment ago. You're already going to have your insurance go up anyways. Now you lost 10% discount, so it's adding another 10% to it. And that's normally for 3 years. That's the legal, I think it's the minimum. I hope I'm using the right word. And for some states, that's also the maximum. That's it. And there are some carriers, while they may not be able to charge you, when I say some, just think of it like 50-50 as I say the word some. So some insurance companies might only charge you for 3 years, but then they underwrite it for 5 or 6 years. So you have to understand, underwriting also means, are you eligible? Are we going to renew you? Are you a higher risk than someone else?
Well, yeah.
Hey, we really could, because I can't stress enough how important it is for people. And this podcast is mostly geared for downsizers. This is information that I think everyone needs. And we really need to make sure that we put Douglas's contact information in here, because here's one more question. I can't stand it. You could go on all day. I have also heard that if you leave your insurance company, then you risk ending up with much higher rates anywhere else. So if someone is settled with a company, but they want to work with you, what happens?
That is also a very good question. And I hope I answered the last question fully there. But this is a very good question for you to ask, Judy. And here's the easiest way for me to explain it. When you have a conversation with me, it's having zero impact on your current insurance. There's no charge for what we do. This is how we choose to conduct business. There's no hidden fee. And I like saying it this way. Let's use Progressive as an example, or State Farm, whoever. We'll use Progressive. let's say you call Progressive and get a quote, and then you call and you work with me. The exact cost is going to be the same. It is not going to be that we added a little percentage or a buffer or a filing fee or a paper fee. Why and how does that work that way? I'm paid a salary. And so that's a huge advantage. That's why I can say I'm an advocate for someone. I'm not pulled one way or another for one insurance company or another. Working with me allows me to do an honest analysis, learn what your risk tolerances are, find out what your assets are, how you want to have them protected, tell you how your policy is responding and working for you today, including showing you actual language in the insurance contract, so you don't think I'm just saying something to say something. And then we do a side-by-side to show you if it was me and you've asked me to do this on your behalf, this is where we recommend that you consider making adjustments. Even if it's you stay with your current carrier, these are recommendations that we have. So you don't even have to call your current insurance agent. We can have this entire dialogue and get to the end result free of charge.
I would recommend, and I intend to take you up on that personally, because I wasn't even aware that a service like yours was out there. And the fact, like you said, so many of us just take paperwork and sign it because the amount that you're paying was acceptable at the time. I don't know what's in my policy, but you take the time to make sure the people understand what they're getting. And that is so incredibly important. And I don't think people realize it until they need it. And then everybody's unhappy because they didn't really understand what they got in the first place.
And to answer the other side of your story is we want to be careful about moving you. We do. That is an important dance. But I'll also say this to you, Judy. If your coverage isn't right, and what we're proposing is far more attractive, and possibly, in fact, I'll tell you 91% of the time, I actually am able to offer a better price than what somebody currently has. It's a high percentage. I just want to say historically, that's 10 years worth of me doing this, collecting all that, even though I've been doing it for almost 21 years now. I've just been keeping track. So literally I can tell how I've done for each client. In fact, it's 91.17% of the time I've actually helped them save money and put them in a better position. You know that if you call your own insurance company back, the rate is going to probably do what?
Go up.
Most insurance companies will not offer you any kind of discount for what they call longevity credits or discounts if you haven't been with your prior insurance company at least 3 years. So we do recommend, please don't make changes.
I think people jump quickly because they think they're going to get I just saw a new one, a company that is claiming that they can cut your insurance rates in half by taking out the middleman.
I've seen one that's even worse than that. Dennis, I don't know if you've seen this one, but I showed it to my wife and she just laughed and walked out of the room because, of course, she's heard insurance conversations when you've been doing it for 20 years. So she understands how this works. I would love it if I, the agent, was getting 80% of the premiums you pay. Think of how many houses I could buy with you, Judy. So what I'm saying to you is marketing. And if we can just stop listening to marketing, because it is doing exactly what we're asking them to do, which is make us feel good, make us feel like we're in good hands, or what's nationwide is on your side. Whatever it is, that's marketing. That's not reality. It's no different than you, Judy, and your clients as they're trying to downsize and they're trying to decide what's best. You're not hawking a bunch of taglines for them to buy from you. You're feeding them facts. You're articulating a strategy for them. You're helping them get to a solution that works best for their situation. And the very next client you help, it's not going to be the same situation. Absolutely. So I hope I'm giving you that answer on saying the marketing isn't going to win you any court case. It's not going to make you whole. It's not going to make you not be upset. What is a better advantage is giving yourself the leverage and the advantage to know what you're actually paying for and update that. So what do I mean by that? If you're not reaching back out to your insurance agent or your insurance advisor once every 3 years, that I would consider to be on the side of dangerous. The rates do change. Every year your policy renews. There's new changes to that policy. Do you still agree to those changes? So there's things that are important for you to know. What are you actually paying for? And we talked about the deductible earlier. That I'm going to rewind to just say this a little bit. Because there are more than one home policy that you can get from most insurance companies, most people just zero in on the cheap one. I like saying it this way. There's a $1,700 one, there's a $2,000 one, and there's a $2,300 one. Most consumers are going to go to that $1,700 one because they think that $2,300 one is ripping them off and they're just trying to make money off of me. Guess what? There's a huge difference. The person that paid for $2,300 for that insurance policy, while they're going through a loss and that part sucks, they probably have coverage. And that $1,700 policy, that person now has the added frustration of getting a denial letter in the mail. Potentially, that is the case. So what we do is we help them understand, how about if we look at the middle policy and this other policy, see which one makes sense for you? And now let's talk about a deductible. And lo and behold, we might be pretty close to that premium. That other policy had thousands of exclusions in it, or hundreds of exclusions, or whatever the coverage you didn't need. And now you're paying the same premium or close, but now you have coverage that you know is going to take care of you the way you want it to, as it's designed on claim day. And that's also why we say, let's talk every 3 years. I don't want to talk in 5 years. That's too late. Let's talk every 3 years. And in our agency, depending upon the client, if you only have one policy with us, this is not going to happen. If you have several policies with us, home, auto, umbrella, so on and so forth, we're automatically checking the market for you in the background. Whether you like it or not, we're making sure you're still landing in the same space. But if you haven't maintained your policy, you haven't told us that you remodeled the kitchen, you haven't told us about the addition to the house, you haven't told us you put a new roof on, you haven't told us you added air conditioning, we're still basing our analysis off of the original information you provided us. So the onus is on you, the owner of said contract, to let us know that there's been changes, because there is a maintenance clause inside your insurance policy that says, ultimately, it's your problem, not the insurance company.
I have to say that has been something that opened my eyes last fall, is that I talked to my insurance company. My original policy for many years was a home that was covered, said its value was $300,000. It's not worth 300. It's much, much more. And therefore, if I had a catastrophic event, I would have been covered up to $300,000, not the replacement cost, or even close to what the value really was. And I did not understand that.
I said a lot of people don't even think about it.
So there had been an addition to the house, there had been a kitchen remodel, and now there's a bathroom remodel. And in the open market, it's selling quite a bit over that $300,000, hopefully. But what critical things do I need to know? And what kind of information would the average consumer do to help them understand this is a very important issue?
So this is probably going to make a few people have the hair rise on the back of their neck. This is very important. I'm going to try and articulate this. And it's only because now we're actually talking about contract language. Now we're talking about the maintenance clauses that are inside insurance contracts. Now we're getting into the nitty gritty. And all of us, every time we've got an insurance policy from a company where we've had a property, all of us have this information. So this isn't like new. We all have this information, but I am a consumer too. And even though I am pretty knee deep into this stuff, I still don't read my insurance policies in total detail, because I know what I'm purchasing, just to be clear. And I do read the renewals because I've been in this industry, but I'm not going to sit there and read 192 pages every time. No, but I am going to be concerned about what is important. So you mentioned the house was being insured for $300,000. Let's make this simple. Insurance, for the majority, there's ISO forms, which is a term of everybody starts with the same document with the same language, and you can endorse that policy to get rid of some restrictions or add coverages in that have been eliminated by the base policy. That also brings in a lot of coverages and basic language inside the policy that changes. However, every single one of those that I just mentioned, your basic, your broad, and your special, there is language inside there. The easiest way to coin it is co-insurance. And without giving you a long example and giving you court case numbers and things along those lines, how about if we just say, in general, it works like this. You have a home. The insurance company keeps sending you a bill and says, would you like this insurance policy to renew? And you just continue to write the check. And now we're 10 years down the road. If that home was a total loss, and let's say it was $1 million, let's just, we're talking reconstruction cost. I want to be clear. We're not talking It's close to the highway, so that adds $100,000 in value. We're not talking it's overlooking the beautiful water and the sunset's perfect every evening, and that adds $500,000. We're not talking about any of those values. We're talking about if an insurance company has to react on claim day, they're having to pay a premium for contractors to be pulled off of current job sites to work on your house that was not a planned construction. Let's be real. They're not going down and getting this great discount, and then ultimately you're the one that's the general contractor anyways to find, or a project manager at least, to get that project done. But as we're looking at this insurance and it's $1 million coverage requirement, there's language in these insurance contracts that say it is you, the owner of said property, whether it's in an LLC, whether it's privately owned, doesn't matter. It's your responsibility to make sure that the reconstruction cost coverage you are being offered by the insurance company fits your needs. It is not the insurance company's responsibility. It is not the insurance agent's responsibility. It's not the tax assessor. It's not the real estate agent. It is, the onus is on the owner of that property to make sure that it makes sense. You mentioned that you added a space and you've done some remodeling. In the insurance contract, one of their outs is you're required to notify them of significant changes. Not, I cleaned the window, I put on a new curtain. That's not what we're talking about. We're talking about if you change the floor, you put a new roof on, you did an addition, you remodel the space, have a conversation with your insurance advisor and make sure the insurance policy meets your needs. Here's where the rubber meets the road. If we're still talking about the $300,000 covers that you've purchased, if we're talking about $1 million, what I mean by excessive is that's very unusual for there to be that wide of a spread. But I'm just using that as an example. The contract says if it's not insured for at least 80% of what it would cost to totally rebuild that structure the day of that loss, this is not negotiable. And the reason that they put that in place is a great example would be if I've been spending a dollar amount each year for that renewal, and I've only had $300,000 in coverage and I keep paying that bill, how can we ask the insurance company where the risk is really $1 million to write a check for $1 million loss and expect that to be appropriate? So they're being kind and saying, since you are only insured for $300,000 and you at minimum should have been insured for $800,000, whatever the loss is, you're responsible. Now, again, 40,000 foot elevation, there's fine print. There's a bunch of different things that occur. I'm just trying to help people understand the critical importance that you need to know what it costs to rebuild your home. Otherwise, here's the alternative. Every day an insurance company is going to call you and ask you what you did to change to your home.
Now,
Think about that.
first, what about the personal property inside the home? I'll give you a perfect example. My husband is a musician, and if there was a fire, he would take his Martin D35 out before me. But he also has 8 other guitars. Now, when we first, I'm sure the Martin was listed because he had it when we did the insurance, but the other guitars we've never said anything about. So what about the personal property?
All right.
In a fire, it's destroyed. Like
So
there's couches and...
I'm going to answer that, but I'm going to go back to the other topic real quickly. Depending upon the insurance policy you put in place, there may be extended replacement costs that get added to the dollar amount that you have for your dwelling, and that is a part of the calculation. You might even be with a carrier that has removed that co-insurance and now they're on the hook. Do you want to be at the mercy of the insurance company on claim day, or do you want to be an informed consumer? You know exactly how that policy is going to react for you on claim day. And I can tell you that the last I heard is what 67% of every home in the United States, is currently not insured appropriately. And that's the federal government making that statement. That's not me making that statement. That's me regurgitating their information. But that means the majority of the folks that you're having this video as reviewed by, even if it's 51%, they're probably not insured to the value that they really think they should be. And let's be honest, what did lumber do in 2022? It went up 400%. Now it's come back down, but what are houses built out of?
Yeah.
Okay, so I just want to be careful that this isn't everyone. We just need to know what you're paying for and be an informed consumer. Now we're talking about your personal property. This is also an important topic because depending upon what your dwelling value limit is, and let's use the same 300,000 number there for just a moment, Dennis. Normally, insurance companies are going to cover 50 to 70% of that dwelling reconstruction cost is automatically extended to you for your personal property. That includes your silverware, certain limits of jewelry, artifacts, antiques, art. They're very low limits. But if you think about your furniture and your dishes and your clothing and stuff like that's what that limit's really for. When we talk about your husband's guitar specifically, I can replace the name guitar with guns, art, collections, and are collectibles. What do I mean by that? You can't see it because it's not this wall, but my wife and I have a lounge in our home, and there might be one or two different spirits in there, and some of them might be worth a few dollars. Okay. So those items fall outside the personal property coverage beyond the limit that insurance company is providing to you. And when we talk about basic, broad, and special, those limits are very low. So it really doesn't usually cover what most people do inside their space. If you do have items that are value to you, or you've made it an investment, or as part of your legacy, you're going to give them to family members or friends or a museum after you go to wherever you go. And when we're not here on planet Earth anymore, you are going to want to make sure that is a separate policy away from your home policy. I want to be clear about that. And that you are listing the items that you want on there. Many insurance companies are going to ask for current appraisals. And why am I saying make it a separate policy? Here's why. If you have that guitar insured on your homeowner policy, you're losing your 10% no claim discount, and you're probably going to see the minimum 20% rate increase because it's a low end loss. You're going to see a 20%, potentially, everything's potential of 20%. So now you're going to see your insurance rates go up 30% for the next 3 years. Wouldn't you rather have that on its own, what we call it a PAF policy, personal article floater? And that is its own policy. So if you're paying $200 or $300 on that a year and you have a theft, that same 30% impact is a little bit smaller than if you're paying $2,000 for your home insurance policy and seeing that kind of an impact.
Wow.
The whole thing about insurance is risk. How can homeowners minimize the risk?
That is a great question.
Maybe at least understand that they've got to understand so they make a better informed choice on the insurance. I think that is important to consider.
So this is probably not the answer you're looking for. And I apologize in advance, but it's an honest answer. And that is to become engaged in the insurance conversation with your insurance agent. You need to make an investment in your time because you're protecting all of the hard work you have been doing. I help a lot of people that come straight from financial advisors. The financial advisor scares the daylights out of them. I give them a soft landing spot, say, okay, I understand where your financial advisor is coming from. That individual is very smart. Here's ways we can reduce those risks. And here's ways we can protect those risks so you're not as exposed as you feel you are today. The bottom line is they need to actually engage and have that conversation. They need to be willing to answer 30, 40, 50 questions, not 5. That is the kind of client that I want to engage with. Otherwise, how can I be an advocate if all you want is churn and burn, give me cheap? That's the wrong path. In fact, I'll say to you, that's probably a self-destructive path in today's environment. You really have to honestly make that investment. And if you look at it this way, you may have purchased an item on Amazon that you did more research on before you bought that on Amazon than you've done on your insurance in the last year.
True.
So I will also say this, if I may. I am imploring everyone, please, if you're putting an offer on a property, the next phone call needs to be with your insurance agent, not the painter, not the plumber, not the designer, not Lowe's for a new credit rate increase because you're going to do a massive remodel. And there's a reason behind it. We are seeing more often than not, unfortunately, we'll get a request from a mortgage. You may not be currently getting a non-renewal notice, but that doesn't mean that if you are buying a property, you as the owner of the property, you may not be getting a non-renewal notice. But that doesn't mean when your consumer or that person at the buyer is looking at the market that the insurance companies are going to say, no, thank you. Yeah. Because when you're already with an insurance company, they're on the hook, right? We just talked about that contractually to a certain point until the next renewal, right? So it's important to have that conversation in advance. And I'm highly advising that it be the next phone call after the acceptance has happened and you high five and you hug each other and you're all excited. When you breathe in and breathe out, the next phone call needs to be to get, and I want everyone to key in on what I'm going to say here. An underwritten and approved quote. I can go get quotes right now at Progressive for landlord policies, investment properties. Just because I can get a quote doesn't mean that when I go through the underwriting process that the premium won't change or the underwriting guideline questions I'm answering no longer fit and you no longer qualify. So instead of running at the last minute, just buying any insurance policy you can get on it, why not be on the front end of that? Why not minimize that stress and have an honest conversation and make sure that everything makes sense? You might want to move from one carrier to another because of the location that you've moved to, or your situation's changed. You have 12 cars going down to 2 cars or 2 cars going to 12, whatever. So I hope that's taken.
Thank you.
This
I
happened to
need
my
to
son,
run.
actually, because he just bought a home and it's a 1955 home. The car insurance company wouldn't insure the home because it was too old. Thanks, Douglas.
So good. And
Yeah.
it's been Douglas, I'm so grateful that you joined us and spent this time with us. And
Thank you. So if
Thank you.
somebody
I'm
wanted
sorry I
to
went long.
don't be sorry. Like I said, we could do this all day on this subject.
So if someone wanted to find you, what would they do? Phone call, email?
Whatever is their preference. I'm on LinkedIn like most of us are.
Information.
Yeah.
Okay.
Thank you.
Douglas Olson, thank you
Thank
so
you.
much. This has been
Dennis, thank
fantastic. Thank you for watching and or listening. Hope to see you soon. Take care. Bye.